Money is a complicated subject. According to Herman Daly and Josh Farley, anyone who is not confused by money probably hasn't thought about it very much. In this lecture, I try to bring some clarity to the confusion. I explore what money is and how it's created. I look at some of the criticisms of our current monetary system and discuss possible alternatives, such as sovereign money creation and a sovereign money system. Lastly, I explore the links between money and environmental sustainability, including the tough question of whether our current monetary system creates a dangerous growth imperative. A variety of things have been used as money over the years, from Paleolithic tally sticks to shells, cattle, gold, through to modern forms of money like banknotes, bank credit, and Bitcoin. Fundamentally, these things only serve as money if society accepts them as money. And this really depends on the confidence that people have in the future purchasing power of a given form of money. As Hyman Minsky put it, anyone can create money. The difficulty lies in getting it accepted. History suggests that one useful way of judging the acceptability of money is whether you can use it to pay taxes and, more generally, buy goods and services in the economy. The standard view is that money serves three main functions. First, money is a medium of exchange. It's an intermediary used in trade to avoid the inconveniences of a barter system. Money provides a common denominator that everyone wants, simply because everyone else is willing to accept it. Second, money is a store of value. It can be saved and used in the future to purchase goods and services. And third, money is a unit of account. Things are sometimes assigned monetary values even if they're not being bought or sold, for example, unsold inventories in a warehouse. Bizarrely, money is mostly ignored in neoclassical economic models, which is one of the reasons why economists were so blindsided by the global financial crisis. Neoclassical economics sees money as a neutral veil lying over the real economy, or as oil for the wheels of exchange. This follows from the view that money originated as a convenient alternative to barter, a view which is not historically accurate. According to David Graeber, our standard account of monetary history is precisely backwards. We did not begin with barter, discover money, and then eventually develop credit systems. It happened precisely the other way around. The bulk of research suggests that money originated with obligations among individuals and communities which needed to be recorded. These obligations preceded market relations by thousands of years. In the conventional view of money, banks are seen as simple intermediaries in the economy, taking in deposits from savers and then loaning these out to borrowers. Now, you can take the blue pill and continue to believe this fairy tale, that most of our money is created by the Bank of England and the Royal Mint, or you can take the red pill and wake up to the reality that most of our money is actually created by commercial banks when they make loans. Since you're studying ecological economics, and you've of course seen The Matrix, I'm going to assume that you take the red pill. Welcome to the real world. In the words of the Bank of England, banks do not act simply as intermediaries, lending out deposits that savers place with them. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. What does this mean in practice? Well, banks can loan, i.e. create, money without someone else having saved it first. Banks are not required to keep a certain percentage, e.g. 10% of depositors' money, and money creation is really only limited by the willingness of banks to lend. For you to understand how this system works, I need to introduce the three types of money in the economy. The first is cash. This is the physical banknotes and coins created under the authority of the Bank of England. However, cash only accounts for 3% of the total money supply in the UK. The profits from printing this money go directly to the government and amount to about £1 billion a year. The second type of money is central bank reserves. This is electronic money created by the Bank of England and used by commercial banks to make payments among themselves. It's not counted in the total money supply, since only banks can use it. The last and most important type of money is commercial bank money. This is electronic money created by commercial banks when they make loans. It accounts for 97% of the total money supply, and the profits from making this type of money go to commercial banks and amount to about £23 billion a year. So how do commercial banks create money? Well, let's say I walk into a branch of Barclays Bank and ask to borrow some money to buy a new car, which costs £10,000. Clearly quite a good deal. Barclays does a check of my income and credit rating and decides I can be relied upon to make the payments on the loan. I sign a loan contract promising to repay the £10,000 plus interest over the next 5 years, according to a monthly schedule. The loan contract legally binds me to make repayments to the bank. As such, it has a value of £10,000 to the bank and is recorded as an asset on the bank's balance sheet. Note that interest is not recorded on the balance sheet. It's recorded as income on a separate accounting statement, known as the income statement or profit and loss statement. Of course, I signed this contract to get some money, so the bank creates a new account for me and credits it with £10,000. This is new money, which the bank has created out of thin air simply by typing some numbers into a computer. Everything is fine because the two numbers, assets and liabilities, cancel out. But in this process, £10,000 of new money has been introduced into the economy. This money is created as debt. In the same way that banks create money when they make loans, banks destroy money when loans are repaid. How does this work? Well, let's say that I've now spent my loan and bought the new car. Woohoo! So I no longer have the money. At some point, I earn £1,000, which I decide to use to pay back part of my loan. The bank subtracts the £1,000 from my account and also reduces its assets by £1,000. In this process, £1,000 has just been removed from the economy. Less debt means there is less money. This leads to something of a problem. As an individual, it's a good thing to pay off your debts. However, if everyone in society paid off their debts, then there would be no money and the system would collapse. This is why the government is always so anxious to keep banks lending anytime there is a recession. From an ecological economics perspective, money is not real wealth. Real wealth encompasses actual resources, goods and services, like land, housing, food, and medical care. Money is simply a claim on this real wealth, and it does not need to obey the laws of thermodynamics. Unlike matter and energy, money can be created and destroyed, and it can grow without limit via compound interest. Real wealth, on the other hand, can grow only according to physical laws. This potentially creates a problem because the money supply can grow much faster than the amount of real wealth. You can see this by comparing the money supply and GDP over time. Between 1970 and 1985, the money supply and GDP grew at a similar rate in the UK. But following deregulation in 1986, the money supply began to grow faster than GDP. It contracted following the global financial crisis, when banks stopped lending, and has grown quickly again during the coronavirus crisis. In the UK, the organization Positive Money has argued that the current monetary system causes a number of problems. First, it provides a huge subsidy to the banking sector and a loss of potential revenue to the government. When a loan is made, money is created. When that loan is repaid, the money is destroyed, but the bank gets to keep the interest. That's a pretty good deal. The system also gives the banking sector a tremendous amount of control over the shape of the UK economy. In recent years, most bank lending has gone into property markets and the financial sector, pushing up property prices. Only 8% of bank lending has gone to businesses outside the financial sector. Moreover, since money is debt, in order to get new money into the economy, households or businesses have to go further into debt. And this creates periodic crises when people are not able to pay back the ever-increasing volume of debt. In the words of Adair Turner, the former chairman of the Financial Services Authority, the financial crisis of 2007 to 2008 occurred because we failed to constrain the financial system's creation of private credit and money. So what's the alternative? Let me give you 3 options in increasing order of how radical they are. The first is to reform the banking sector and try to exert more democratic control over the creation and allocation of new money. This could be done by breaking up the big banks to try to put an end to too big to fail, by nationalizing banks, or by setting up more small, locally owned banks. It could also involve implementing credit guidance or other macroprudential tools to encourage banks to lend to specific sectors of the economy, such as green energy. The second option would be to allow sovereign money creation. This has a number of other names, such as strategic quantitative easing, QE for the people, or direct monetary financing. The basic idea is for the central bank to create new electronic money, which it would give to the government to be spent on democratically determined priorities. These priorities could include funding a low-carbon transition, paying down the national debt, or dealing with the coronavirus crisis. And the remarkable thing is that after years of monetary campaigners arguing for sovereign money creation, it's now happening in the UK. On April 9th, 2020, the Bank of England became the first central bank in the world to adopt direct monetary financing to fund spending during the coronavirus crisis. This is not money that the UK government has borrowed, it's money that the Bank of England has simply created. And while the Bank of England has called this a temporary measure, there's no reason that it needs to be. The third option would be to implement a full sovereign money system. This would allow sovereign money creation while also taking the power of electronic money creation away from commercial banks. Similar proposals include 100% reserve banking or full reserve banking. In a sovereign money system, new money would enter the system through government spending and exit the system through taxes. There would still be private banks, but how they worked would be rather different. There would be two types of banks. Deposit banks would operate the payment system and provide a safekeeping service for money. They would likely charge a fee for these activities. Lending banks would act as intermediaries between savers and borrowers. Lending would actually involve the transfer of existing money and would no longer result in the creation of new money. There are at least three environmental arguments that have been put forward in favor of a sovereign money system. First, it would give governments more ability to pursue environmental objectives by financing these directly. Second, the current system tends to lead to quite high levels of both private and public debt, and this debt is hard to pay down without economic growth, which is bad for the environment. And third, interest payments themselves may create a type of growth imperative. Now, whether interest payments actually create a growth imperative has been actively debated within the ecological economics community. The debate starts with a simple observation. If I take out a loan, it's not just the loan that I have to pay back, but the loan plus interest. And if everyone is doing this, taking out loans and having to pay them back, then it would seem that the total money supply would have to increase over time. However, this argument assumes that interest payments are somehow taken out of circulation by banks, which they are not. Interest paid to banks is redistributed as wages and profits to the bank staff and shareholders. The same stock of borrowed money can in fact flow round and round in the economy many times, and ultimately it's the flow that's important, not the stock. A number of authors, building on post-Keynesian theory, have developed mathematical models demonstrating that it's possible to sustain a stable level of economic activity and pay interest on the entire money supply without injections of new money. That said, a recent book chapter by Roman Schwarzman and colleagues argues that from an institutionalist perspective, interest-bearing debt does create a growth imperative via its link to capitalism. The authors argue that the application of post-Keynesian theory to the field of ecological economics is insufficient insofar as it fails to explore the institutional dimension of money. In particular, the generalization of interest rates that emerged during the Middle Ages represents a historical shift that is intricately related to the establishment of capitalist socioeconomic systems whose main goals are to endlessly accumulate money. In other research, positive money have suggested that even if the payment of interest doesn't create a growth imperative itself, the current monetary system may still make us dependent on growth because it's very hard to reduce the level of debt in the current system without relying on growth. In a recent report entitled The Tragedy of Growth, positive money argue for a number of transformative policies for post-growth money and finance. Besides monetary financing, i.e. sovereign money creation, These include a universal basic income issued via a central bank digital currency, a direct clearing facility to record debits and credits between firms, small-scale public banks grounded in local communities, and modern debt jubilees to forgive debts. So, to sum up, most of our money is created by private banks when they make loans. But this important role of the banking system is largely ignored by mainstream economics. Money is an abstract social construction which does not need to obey the laws of thermodynamics, unlike real wealth. Whether the current debt-based monetary system creates a growth imperative continues to be debated, but irrespective of this debate, tools such as sovereign money creation could be very important for making the transition to a sustainable economy.